Hello, and so we just spoke of the measurement, and we said that this measurement actually can be explained in terms of historical cost, but also in terms of the current value, the worth now. What is the worth now? And for historical cost, actually, we define these two ways for assets and for liabilities. And our main concern right now is on defining the current value. How do we determine the current value? How are we going to do this? We say that it measures provide monetary information about assets, liabilities, and related income and expenses using information updated to reflect conditions at the measurement date. So simply speaking, it uses updated information rather than historical information. And actually, there are different ways here. We say that we can have three different ways. That is fair value. We'll see how. Also, we have something called value use and fulfillment value. We're going to see them that soon. Then lastly, you have something called current cost. So it's just cost just like historical cost, but this cost is not historical, but it's also a cost. If you say you have a cost, that means you have an asset, you incurred, you paid something. And if it's a liability, that means you received something. And that's how we define them when dealing with the historical cost up here. If you can remember, consideration paid to acquire or create an asset plus transaction cost. While for liability here, we said that the consideration received to incur or take on the liability minus transaction cost. Now, maybe to go well, I should try to tell you one thing. Why don't we go to the current cost again? Because since we're speaking of historical cost, instead of starting with fair value and value news, why don't you first finish with this current cost so that we can distinguish them properly? All right. For the current cost rather than historical cost now, it is the same thing that it has to be paid. If you, to acquire an asset, you have to pay. So for an asset, it is the cost. Now, instead of saying the cost of an asset, say the cost of an equivalent asset, because you might have bought an asset 5 years ago, but up to this point now, maybe it is on a certain condition, right? So you would need to know for how much would you be able to purchase now the asset in that condition right now. All right? That's what we call the current cost. So it is the cost of an equivalent asset at the measurement date, comprising the what? The consideration that will be paid at the measurement date plus the transaction cost that will be incurred at that date. By saying this, it is exactly the same definition as for historical cost, but we just specify the word at the measurement date at the measurement date. And also the word the equivalent asset. For that asset, for how much will we have to pay and for it and for transaction cost to have something like that. So simply speaking, when they speak of the word cost, they refer to how to acquire something, either to acquire something or to extinguish something, to acquire an asset, or if it's a liability, how did you obtain that liability? Let's just say that we can use that one to acquire an asset or to acquire a liability. So for a liability, we say, to have a liability, that means you have to receive something, right? So it is the consideration that will be received for an equivalent liability at the later minus transaction cost that will be incurred at that day. That's why the definition is just like the same, because I will refer to the same thing, but now we are just trying to speak at the specific date rather than the past period. Now, we have the remaining two things here, fair value and value news. Before reading at these definitions, you have to get the concept on what we focus. I'm repeating again. When speaking of cost, we mean that how did you obtain, for how much did you pay, how much did you pay to get an asset, or how much did you receive to obtain the liability, to incur that liability, to have it in your books. But when speaking of fair value now, this one is different. By fair value, let me be specific to assets so that we get it more clearly. By saying fair value or value news, we mean that, presume that you already have an asset. So for those costs, it's like we are trying to acquire an asset. But now say that you already have an asset, but you need to dispose of it. If you have an asset and you need to recover the money from it, you have two ways. It's either you can sell it or you can use it to generate funds for a certain number of years before you dispose it, right? And that's what gives you this definition of fair value and value news. So do not just study this one in vain. You should know why you are doing this. For the cost, we are speaking of what we would incur to get them, to have them in our custody. But for fair value and value news, how much would you obtain by trying, how much could we recover from the cost that we incurred? How much? It's either by selling, so we're speaking of fair value, or by continuing use, we're speaking of value news. And right now, I can go and define this one very easily. When speaking of fair value, that means you need to sell something. You have it already, you need to sell it. So that's why we say it is the price that would be received to sell an asset, right? You already have an asset and you are selling it, so that's the fair value. But here, this definition here combines assets and the liabilities in one definition. That's why we say, or paid to transfer a liability. You know, if you are liable, you have a liability. The only way to extinguish the liability is to pay, right? Now you have to understand ourselves. I do not mean here to pay to actually pay. We mean to transfer a liability. You know, there might be a difference between transferring a liability and paying a liability. Maybe you have entered into an arrangement to say, oh, you mean that if you go and pay someone, you pay $10 million. But maybe there can be an arrangement that you can pay someone else and someone else can assume that responsibility. And maybe the bank may be given fairer terms because the bank wouldn't just allow you to trust the liability. Maybe convince them, oh, you will be paid by this one, but this one will pay you more, much more. You can have that. Let's say someone cannot secure the loan from the bank directly, they have to use you, something like that. So it's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction. What do we mean by an orderly transaction? You know, you can be selling something because you're in great problems, you do not have money, you have a patient at the hospital, maybe the patient is about to die without having proper medication. So in an orderly transaction, that means that the business took place when all parties were at just normal conditions. Not maybe someone was in a great debt, maybe the house was about to be taken. No. That's why we say in an orderly because this is fair, the price is fair, otherwise it wouldn't be fair. Again, between market participants. By saying between market participants, it means that these participants have information about the market. You know, you might go to a market that you are not aware of. Something might be sold to you for $60 million, $6 million, while it is actually worth only $4 million. But because you do not have information about the market, you pay that. That also wouldn't be a fair value, right? And the last portion here says at the measurement date. By the measurement date, this point also is very essential. You know, today you can have a fair value of $6 million. Fast forward 2 weeks, and that fair value is $7 million. So we have to spell the measurement date. It's very important. The volatility of fair value on assets depend. Some assets some assets can be very, very volatile. So you have to take a look on this. So that's what we spoke of the fair value, the way to recover the amount from the cost you incurred. That's why we started defining the costs. And then you have value news. Now you speak to yourself, oh, I do not need to sell something like this. I don't need to sell it. Let me just use it and it will generate cash flows sufficient actually to obtain to recover that cost. That's what we call value news or fulfillment value. Now, value news is used for an asset and the fulfillment value is used for a liability. If you have an asset, maybe, and you say that, oh, if instead of selling this asset, if I use it, I would obtain $1 million at the first year, at the end of year one, $2 million at the end of year two, $2.5 million at the end of year three, and at the end of year four, I would obtain another $1 million, and maybe I would dispose it for $0.5 million. So you have your cash flow from year one to year four. So if you have a cash flow from year one to year four, you just ask yourself, oh, I'm here now. I just need to know the weight of all those receipts in future years now. So I would have to determine the present value, which is usually the future value divided by 1 plus R power n. If you have ever encountered something called time value of money, just like this. This is how you take the present value. So you take the present value of all cash flow that you expect. Now, usually, if you need to do this R here is usually called the discount rate, the discount factor. So you have to discount. So I'm just presuming, let's say maybe at the end of year one, you have 1 million. So you divide by 1 plus R. Let's presume R to be 10%, which would be 0.1. So 1 here plus 0.1 would be 1.1 plus. Then I would go maybe in the second year, I expect to have 2 million. I would divide by 1 plus 0.1, but here power 2. So I would say power 2. Let's say at the end of year 3, I would have 1.5 million, but also I would sell it for another 1.5 million. Then I could have 3 million. Then I actually discount it again for 3 years, just like this, and I will have the present value here, and this will be my value in use. That's why here we say value in use is a present value of cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. We used it the first year we obtained 1 million, the second year 2 million, the third year 1.5 million, but also we dispose it at 1.5, giving us a total of 3 million. And again, now when defining the fulfillment value, we say this now is a liability. Presume that you have to pay this amount to the bank. At the end of year 1, you pay 1 million. End of year 2, 2 million. End of year 3, 3 million. You pay all these amounts and then you discount them, you obtain the value, the present value that you would have to fulfill so as to be deprived of the loan that you owe the bank. So the fulfillment value is the present value of the cash or other economic benefit that an entity expects to be obliged to transfer now, not to derive, not to be them, not for the entity to own. Now it is obliged to transfer if it fulfills a liability, and that's why we call it fulfillment value, just like that.
Sorry, Fred.
Yes.
Let me understand
yes.
the value use here.
Yes.
I understand what you explained on value use.
Yes.
Now, fulfillment value, under what circumstance does it arise?
Oh, fulfillment value is just like value use, but it's just for defining a liability. Because if you define a liability, you do not call it this value, not call it, you do not derive a value. So it's a value that you have to fulfill so as not to be liable for the debt. So fulfillment value is just like value use, but this one is for a liability. Let's say you owe the bank, you have to pay them 1 million at the end of year 1, 2 million at the end of year 2, and maybe 5 million at the end of year 3, right?
Yes.
Now you ask yourself, without considering time value of money, I would say 1 million year 1, 2 million year 2, 5 million year 3. You would say that is 8 million, 1 plus 2 plus 5, right? But we say that since we are given the space, we are not paying that 8 million in a lump sum now. We will be paying it in spaces and actually including in the future. You just discount them. If you discount them, maybe you could remain, instead of 8 million, maybe it could be maybe 6 million. So you just find out that, oh, so the value that I have to derive and pay to the bank so that I can be free of the debt is 6 million. And this is what we call fulfillment value. And that's why the definition itself ends with as it fulfills a liability. You find this word fulfill here. Do you get that?
Yes, I did.
All right. So now let's just finish up. I think we have this one and the last page. Selecting a measurement base. Now you are just asking yourself, oh, which base should I select? Should I use fair value? Should I use historical cost? Should I use value use or fulfillment value, or should I use current cost? You ask yourself. That's why we say the information provided to users by the measurement base must be useful. So simply speaking, if you should just try to explain why you have used this measurement base, a certain measurement base. Of course, when studying IFRSs, this one becomes very obvious because most IFRSs explain themselves how to measure things. So, for example, say it must be relevant and offer a faithful representation of the transaction that have occurred, just like for recognition, right? Or maybe if you remember when spoke of it, we just said that we have to fulfill these two qualitative characteristics that are fundamental: relevance as well as faithful representation. That's what is very important there. So yes, just a continuation of those factors. For example, maybe we're just speaking of relevance. What point would you look at? They say here, when selecting a measurement basis, the relevance is maximized if the following are considered. How do you maximize relevance? For example, you have taken a look at the characteristics of the asset or liability. You just take at the asset or liability and you'll find out that, oh, for this asset, I can determine something or I cannot determine it. You know, usually when speaking of things like fair value, that one is very useful, but it really depends on the standard. That's why you say this is just a conceptual framework. For example, you can have the property, plant, and equipment that you have decided to measure at cost. If you have decided to measure at cost, that means you cannot use fair value even if you want to, right? But also we say the way in which the asset or liability contributes to future cash flow. You can also consider that. You know, there are, for example, you can have an asset, but it can be very difficult to determine the cash flow that that asset generates each year. Maybe 1 million, 2 million, 5 million. It's difficult to obtain that. So if it's difficult, you can just use other basis. But also, as for faithful representation here, I'm just trying to say that it helps to avoid the measurement inconsistency, which we usually call an accounting mismatch and the measurement of uncertainty. You know, for example, you know, there are some situations that I can have an asset, maybe that is there and has been financed by a particular liability. So you can just take a look, oh, how is the liability measured this way? And then you can measure the asset that way too. So it's just a way of choice. But other factors could be maybe considering now the enhancing qualitative characteristics. You know, relevant and faithful representation where the qualitative, where the fundamental, right? We can also consider the enhancing factors, but maybe also you can consider factors specific to initial measurement. If you're doing initial measurement, for example, you know, there are situations that you have to consider depending on the standard itself. That's why they're just saying factors specific to initial measurement. There are assets that you acquire through exchange. You give your asset, you give the asset, you receive the asset. So you start those when dealing actually with specific standard. For example, maybe you're dealing with PPE, property, plant, and equipment. You start that. And again, we say that this applies to the ISB when developing or revising an IFRS. It's obvious because the ISB refers to the conceptual framework to obtain an accounting standard, to make an accounting standard, right? That's why we say a conceptual framework is just a guidance, and we say it also applies to preparing the financial statement when applying IFRS standards. Simply speaking, they refer to the whole of the conceptual framework. And so let's do this. Let's go to presentation now and disclosure. We have seen recognition. We have seen how to measure. Now how to present. You know, we say that this is maybe you have the property or maybe you have the plant. We know that we have to recognize it at maybe $20 million. No, how do we present it? You have known that something is a non-current asset to present it as a non-current asset, whether it's a current asset, whether it's a liability, so that you can present them properly. So we say effective presentation and disclosure. Actually, what do we mean by that? It's just a balance between allowing entities to flexibly report relevant information about their financial performance. We mean statement of profit or loss here, position, statement of financial position, and requiring information that enables comparison to be drawn year by year with other entities. You know, when making the presentation, it is nice that you prepare in such a way that you can enable comparability, which is also an enhancing qualitative characteristic factor. Okay. All right, so we say that, you know, there are some other points that anyway just try to complete, but the main concept remaining here is a concept called concept of capital and capital maintenance. That one is the last concept. There are some concepts here, like this aggregation and what can also be defined in S1, but since we won't do that directly, we have to proceed with this. As SBR does not require to do IS1. So the board believe that the entity-specific information is more useful than the standardized description. Of course, that's obvious. An entity can have its assets that are facing a specific thing, and so they should disclose it. But also, duplication makes financial information less understandable. Let's say you're explaining something twice or thrice. It just confuses people. So let's go to classification here. Classification of an asset or liability into two separate components may provide relevant information if the components have different characteristics. All right? By classifying an asset or a liability into two separate components, let me give you a nice example here. You can have an asset and you can say that maybe this one is a non-current component and this one is a current component. Let me ask you one thing, and this one is most common in leases. Let me just, this one is most common in leases. Let's say you have a lease liability. This year you have a lease liability of $2,000, just like this. But we say that 1 year later, you will no longer have $2,000. You will have just $1,500. What does this mean? This 2,000, that means after 1 year, I would still have $1,500, meaning that this one is a non-current liability, right? Because non-current liability lasts for more than 1 year. So even after 1 year elapses from here, I would still be having 1,500. So you can say, oh, so this is the way. What would have vanished, $500 would have vanished, and I would call this as a current liability. I hope you get me. That's why we say classification of an asset into separate components may provide relevant information if the components have different characters. So it's just something like that. You have to know that. And then we say offsetting classifies the similar items together and is therefore generally not appropriate. Of course, by offsetting, let me ask one thing. You have an asset and you have a liability that are related, and say you say, oh, I do not need to show them separately. Since they are the same thing, let me just cancel them out and show a single line item. A good example here is, there is something called International Accounting Standard number 9, employee benefits, and it actually is ISBR, employee benefits, right? By employee benefits, if you have employee benefit, you usually put a pension plan in place. And by putting a pension plan, that means you have assets, you have plan assets, but also you have plan liabilities, because you have put these assets in place, you would invest, and the money obtained should be used to pay off those guys who are maybe retiring, things like that, all right? Or it's kind of compensation. Now, the standard itself requires that you do not need to show the plan assets and the plan liabilities specifically. It needs you to show the net plan assets or net plan liability. This is the standard requirement, but unless the standard stated that, I would have to say that plan assets would stay in the statement of financial position and the plan liability on the statement of position, but under non-current liability, let's say. And maybe plan assets could be under non-current assets of the financial position. But since the standard allows to net them, you can net them. If it's a net liability, it stays on liability. It's a net asset, it stays a net asset. But you cannot decide by yourself, oh, let me do this, let me offset. That's not allowed. Usually not allowed. That's why I say it is therefore generally not appropriate, although it can be done. So you just have to know that. And then you have something called aggregation. Now, aggregation is a combination. You combine this. Maybe you have several assets where you say, oh, let me put this asset as a single line item. We say that it refers to the adding together of items that have shared characteristics. Let's say you have property, the standard called I-16, property, plant, and equipment. We usually put them as a single line item because it's allowed, the standard allows, right? So aggregation is useful because it summarizes information that would otherwise be too.
Hello, sorry,
Yes,
Freddie.
yes,
Freddie, sorry.
yes, yes.
Okay, under classification, uh, where you said classification of an asset or liability
Yes,
into separate components may provide relevant information if the components have different characteristics.
yes, yes,
Now, you were talking about offsetting classifies dissimilar items together and is therefore generally acceptable. If I have loans
yes,
in a bank, if I have
yes, yes,
loans
yes,
in a bank and also have another account that has a debit balance, as in I have some funds in the same in a different account,
yes, yes.
and while preparing the
Financial
bank,
statement.
yes, the financial statement of financial position.
You mean
Now,
to
under
net the cash
cash
and the
and
loan?
cash balances,
Yes, and the loan.
yes, under cash and cash balances, can you offset?
No, you cannot offset those. You mean to offset those loans or what? Or you mean to offset the loan
Yes,
in the cash
like
balance?
let's say I have no, the loan is not collateralized, but the loan, let's say, is an overdraft
Yes,
of let's say $50,000,
yes, yes.
and I have $100,000 in my current account.
Okay.
Now it is in a different current account. Now, for the purpose of presentation, can you offset the $50,000 loan from the current account balance of $100,000?
First of all, if I don't know if I got you well, but you just spoke of your own account. You mean the account not belonging to the business?
No, no, I'm talking about
Yes,
say I work for a company, and the
yes,
company, I am preparing the financial statements for the purpose of audit.
yes,
Let's say the management account now, and
yes,
is it right to to show all information regarding cash and cash balances and the loan, or can one offset since the loan balance is lower than the cash balance
yes.
on the bank statement or on my current account?
Oh, okay. I just got you. First of all, that is only possible if maybe because if you just took the loan from that same bank, or there are some banks who do the coordination. There are some banks who do the coordination in such a way that when speaking of the bank overdraft, if you have overdrawn something, it is just whenever money entered there, it just disappears directly. Is that right? Let's say you have an overdraft of 10 million and then you have deposited 6 million. That 6 million won't appear as the cash, as your own cash. Actually, it would disappear from the bank and the overdraft would remain at 4 million because there was 10 million and then you put that amount, that other amount. So even if
Yeah,
there,
but
you have,
you
you
know
have
that
different
in
accounts.
some cases,
Yes,
hello, in some cases, you
yes,
may have a company may have up to two accounts,
yes, yes,
current account one, current account two, and in current account one, that is where you have the overdraft,
yes,
and the balance is $50,000.
yes,
That is to say you are owing the bank
yes,
$50,000, but in account two, current account two, you
yes,
have $100,000 to your credits. That's
yes.
what I'm asking. Is it right to offset
Yeah,
while
in that,
preparing?
yes, yes, yes. In that case, you can just also, it's just the same amount of cash you're just dealing with. You can just offset, but you would stay there because in that case, you would have to, or maybe I think what you meant is you have the cash balance, but it's not a cash, it's actually in the bank, and so that one is an asset. And then you have the overdraft. That's what you meant, right? you also have the overdraft. In that way, that is an asset and a liability. And most companies choose not to do that. They just choose not to do that. That you show the bank balance separate, but also you show the overdraft separate. But actually, in practice, it's also allowed. It's also allowed to offset those ones. You as a company overall, you can just do that in the company overall. But for a better presentation, actually, it shouldn't be done that way. You should show the balance